All right, guys, welcome back for another video. In today's video, I want to discuss a hypothetical scenario of, say, somebody approaches you with $1 million and says, "Manage this money for me." How would you construct a portfolio, and how would you build that out? And one of the hypothetical conditions to this scenario is that you haven't been involved in the market, and this is your first time entering the market. Um, Assuming that you are experienced, you do have a skill set, but you just haven't been affected by the previous price action. Um, so, in order to get a broad feel on the market, you have to look at the long bond yield. And then in this case, I'm looking at the United States 30-year government bond yield on the weekly. Um, and the reason why I chose the 30-year is, essentially the further out on the duration you get on the bonds, the more signal there is and less noise. And that's because the shorter duration bonds tend to be more manipulated and purchased by central banks, whereas the longer term bonds are more market forces acting on them. And you can see here that, you know, uh, I marked off the March 2020 event, and you can see that, uh, the bond market has been pricing in inflation ever since. It slowed down a little bit here, and a lot of the quantitative easing didn't start until the summer that year, but then it really took off. In this area here is where, it wasn't until November 2021 where the Fed, publicly acknowledged that inflation isn't transitory and they need to fight it and start raising rates and doing quantitative tightening. But the bond market was pricing this in well before that, and yields were rallying as quantitative easing was taking place. And of course, naturally, you've seen yields rise as well to chase inflation. Now, of course, yields are at on a 30-year is at 3%, so you get 3% of your money back. And if inflation is at 15% year over year, after 30 years, you're not going to have any money left, even with that 3% yield. But you get the idea. The yields generally, pursue that return, even though it's ultimately a negative return. Um, Now, I just want to run through a few things. Go back to Bitcoin and talk about the state of the Bitcoin market and where we are as far as capitulation. So right here, you see, people have discussed: Are we in capitulation? Are we not in capitulation? Well, this chart here from Glassnode shows that objectively, the most net realized profit and loss ever in the history of Bitcoin has been taken recently in the recent dip. So this is data. I mean, the data is what it is, and it's showing you that more people have taken realized losses than any other time in history. So um, it's hard to find a way not to call this capitulation. I mean, it is capitulation. Now, of course, people will say, "Yeah, but they could capitulate more." It's like, okay, well, you're at a historic level and an extreme outlier, and these are the opportunities that you know offer the greatest opportunity when you get to those type of extremes. So some of these other, this is the realized price. This basically shows the last spent price of all the Bitcoin on the network, and basically, it just represents the average price. Really, um, nothing too significant there. This Bitcoin hash ribbon shows when these things start to curl over. That's a sign of minor capitulation. You saw that here during the China sell-off. When China banned Bitcoin, you saw that curl right there. Again, not too significant. Here we also have another Bitcoin miner capitulation tracking. Basically, what you're seeing is these different miners are liquidating their treasuries and getting Bitcoin off their balance sheet to fund their operations, or they're just going out of business entirely. Here's another example of miner net position change. You can see here miners are you know selling objectively, distributing on the market. And finally, here's the miner. What this red area represents is the average cost of production for to mine one Bitcoin. And again, it's a broad region, so it's not one specific area. It depends. There's a lot of different variables that go into it, but broadly, the cost to produce a Bitcoin falls somewhere in this region, and maybe you can average that and just say 20, 27,000. But right now, current market price is trading well below that 27,000 cost of production. And just on an obvious level, that causes some issues for the miners because there's just no margin there, right? If you have to spend $27,000 to mine a Bitcoin that's only worth 20,000, you're going to operate at a loss, right? So these miners have to, at the very least, pull off some of their rigs, shut down some of the hash power, and and on the more extreme side of that, just go out of business or sell Bitcoin to keep themselves afloat. And I think that's what you're seeing now. I don't have it pulled up here, but there are significant minor inflows into exchanges currently. But getting back to the price chart and revisiting the idea of how would you construct a portfolio based off if somebody gave you $1 million, what you know how would you allocate that? Well, I'd have to revisit my idea that commodities are entering a secular bull market. A lot of people's opinions on risk assets are based on what the dollar currency index is doing. So a lot of investors' appetite for risk would be based on where they think this chart is going to go. Again, it is setting new highs, but again, it is the time to enter after a parabola? No, it's really before the parabola. But even regardless of that, the the thing about Dixie is that it's showing you strength versus other fiat currencies that are debasing faster than the dollar. So it's not like the dollar is increasing in purchasing power. It's actually gone down in purchasing power. And you can see that in commodities, right? The commodities broadly are going up in price. You see that in oil. You can see that in other major commodities. And so the first thing I would do if I were going to construct a portfolio is I would essentially create allocate to a basket of commodities. And how would I choose which commodities to allocate to? Well, I'd just choose the most liquid commodities to construct a portfolio, because that's how the major asset managers look at these types of markets. They just look for the most liquid markets. And for commodities, that would be oil, natural gas, gold is the top three, but also soybeans and corn futures. And so, you know, I guess the allocation to each would be a little bit different. But say you just allocate a 50% to commodities and just split it evenly between the five most liquid commodities. You'd have a 10% oil allocation, 10% natural gas, 10% gold, 10% soybeans, 10% corn. Well, that way, what you're betting on in that scenario is that commodities will enter a bull market. You're not necessarily speculating on which commodity will outperform the others, right? I mean, it's easy. You could see how somebody could create a narrative that oil would outperform the others, and it would be a very compelling narrative. But really, if you just allocated 50% to oil, there's no way that's going to have a higher risk-adjusted return than the spreading out that among the other five most liquid commodities. And I think the most important one there, and this will tie in later, but gold is very important as a commodity to have an allocation to, and I'll discuss that later. But I would throw in that argument for commodities bull market. I would throw in Bitcoin, and because ultimately I believe that Bitcoin is a commodity and it will trade in a correlation with commodities as the market matures, because really it's monetized energy, digital energy, and so it should reflect the prices of energy. Um, I think the market will move in that direction more over time and break the correlation to equities more so, because Bitcoin is not an equity. It doesn't have cash flow. The same, the type of investment theses that would lead you to be bullish on equities just don't apply to Bitcoin. They typically apply to commodities. So, and then, so you have your 50% allocation to different commodities. Now, how do you choose the allocation to Bitcoin? Well, that depends on your bullishness on the asset, and of course, it's difficult to hold that after you see a price decline like this. But really, from a portfolio management perspective, you know, the fact that Bitcoin has gone down 70% from the highs is, actually should make you more bullish on it on a fundamental portfolio construction level. Um, Again, it's not fun to hold through that, but this is assuming somebody is approaching the market with fresh eyes, haven't had to endure this drawdown, and they're just approaching the market fresh. Maybe they're saying, let's put a 200 exponential or 200 simple moving average. So we just put a 200 simple. Of course, there's other ones here, but this yellow line is a 200 simple. Maybe they're coming to the market and they're saying, okay, look, Bitcoin has sold off 70% from the highs. Generally, that's in line with other sell-offs. It's hitting this area, the 200 exponential, where typically, price sits in a macro low. Even if it closes below, like here in March 2020, closes below. But in the broad picture, this is where you don't want to really get in the weeds, right? This is a very macro area, right? So it's going to take time to play out. This is not a great time to get in the weeds with different details on small time frames. So maybe, depending on those factors, maybe allocate a 20% position to Bitcoin. That seems pretty fair. You know, Considering a lot of people are 100%. But this sell-off is really dramatic, and really, I think this has broken the psyche of a lot of investors. This type of volatility. Not only is it down 70%, but the final, not the final leg, but the most recent leg, um, from this area here, the top in up there in April. That's a 58% drawdown with really no buy, no bounces, and that's extremely dramatic. I mean, this I've honestly never seen anything like this, right? A 58% drawdown with no relief rally. And I think that's why you see this Bitcoin capitulation peaking, right? Because it's just relentless sell pressure, and there's just it's just price has just been on the gas to the downside the whole way. But maybe, yeah. So now we have a 50% allocation to commodities, 20% allocation to Bitcoin, and you want to make sure to have an allocation to cash portfolio in these types of environments, because you just don't know, right? The Fed is tightening, drawing liquidity, so it does help to have some allocation to $2. And the reason why I chose the number 20% is because of the Pareto principle. You have a pattern that occurs in nature, the 20/80 rule, which is that in a lot of natural systems, 20% of the inputs produce 80% of the outputs. So that 20% figure is a number that I use pretty consistently through my methodologies, just because it has an asymmetric effect in the way that it produces results. So that's the reason why I chose the 20% number. And I guess that leaves you at 50% commodities, 20% Bitcoin, 20% cash. Again, this is totally hypothetical based on the premise that the bull market is going to continue, and the bull market in commodities is going to continue. Not, and then that would leave you at 10% to some other random allocation. But the idea is that to get those allocations correctly, and then to trade them dynamically, right? You want to actively manage those and trade them, so that if you think of the entire portfolio as a whole, that you're sort of maintaining those allocations, but maintaining a distinct relationship between the different categories. So, for example, within commodities, you would want you would more you'd be more prone to rebalance within the commodities basket if you have a basket of the most liquid commodities, because you don't know, at least I don't know, which would provide that higher return. But if you're including something like Bitcoin, then one thing you want to keep in mind is that you don't want to rebalance Bitcoin within a portfolio. So the reason why I didn't, I chose a relatively low allocation to Bitcoin. It's still higher than a lot of fund managers. A lot of Fidelity chose the number 5%, but the reason I just chose 20%, relatively low compared to say 100%, because the risk adjusted return and the Sharpe ratio of Bitcoin are so high that if you're managing a large amount of money, you really don't. It actually you don't need a high allocation to Bitcoin. It can a lot of the benefits are actually seen at some of the lower allocations. And getting back into why you wouldn't want to, uh, rebalance Bitcoin is, say hypothetically, you constructed that portfolio here and you entered 20% um, in Bitcoin. Well, if you consistently rebalance to demand that 20% allocation, in the scenario where Bitcoin does rally and start setting new all-time highs, not only setting new all-time highs, but say going into a bear market and getting some type of, excuse me, a bull market and getting some type of sustained rally above the highs. Well, if you rebalance in that scenario, the Bitcoin in that scenario produces so much upside gains that you'll basically be rebalancing all the profit away, and you'll be selling into that rally, right? Which is exactly what you want to avoid. If you have a Bitcoin allocation, it should represent your appetite for risk, and then also, but the very important point I just mentioned was not to rebalance, because you will end up basically limiting your upside while doing nothing to mitigate the downside of that allocation. Anyway, I hope you guys like this video. If you guys like this type of content, please just make sure to subscribe to the channel, and I'll catch you guys in the next upload.